Thanks for joining us here at the Funding Startups panel. We have three gentlemen here who really know their stuff, and I'm excited to talk to them. I'll just do like really brief introductions, and maybe they can do some additional introductions after that. Over the end, we have Ryan from Seed Invest, we have Dan from Pantera, we have Travis from DCG. These guys know their stuff, and we're going to ask them some questions. We're going to talk for about 25 minutes. We'll have about 5 minutes for audience questions. Make them good. We'll have a good time. So first of all, Dan, I just wanted to start off with you. I think I stole this from like a Pantera investor call. So there was like a pendulum swing, right? And the ICO boom sort of stifled VC involvement in the space. And we're seeing this pendulum swing back toward the preeminence of VCs in terms of funding startups. So I just wanted you to sort of set the tone for us, give us a level set in terms of, you know, where we're coming from and where we are now here in mid-2019.
Yeah, I think it's a good topic. There's sometimes a perception that tokens and ICOs were essentially invented 2 years ago today in Consensus or Token Summit the next day, and they kind of did their thing and then they're kind of over. And the reality is they've been around since 2013. They're just really rare to be able to come up with a token that's absolutely required for the functioning of the network. And so you had one or two a year, you know, Ethereum in 2014, Augur in 2015, but they were very, very rare. And then they exploded into people's consciousness roughly 2 years ago here, and people run around talking about non-dilutive finance. Man, if that's not scary, you know, you really aren't thinking. So a lot of projects got launched. The token really isn't necessary. Very little information was given to investors. We were getting 50 white papers a week. It was just mania of stuff coming in. And so that really did suck out a lot of the oxygen from the venture side of the business. There was a period of 9 months that we only did 1 or 2 venture deals. I think the pendulum swung way back to what I would say is normal. It was kind of once-in-a-life mania that we had in 2017 and 18, and we're going back to where ICOs are still incredibly important. Last week we announced we invested $5 million in Blocksprout, a really amazing layer 0 scaling solution for the network. But we've only done 3 ICOs in the last 9 months. It's very rare. And venture's now caught back up. There was a period in Q1 of 2018 where ICOs did 91% of all the fundraising in our space. That was a little excessive, and it's swinging back to a more normal level.
So maybe I can speak a little bit more to where we are in the financing cycle for blockchain startups. So first off, I think we're probably on the cusp of seeing a significant uptick in new company creation and venture capital dollars pouring into the space. The reason being is that what we've seen over the years is that venture capital dollars in the space tend to follow what happens in the open cryptocurrency markets. So what happens is the price of crypto goes way up, it brings attention to the space, which brings venture capital dollars and, critically, new talented entrepreneurs into the space. And there's a symbiotic relationship there. The founders move in because there's dollars available because there's, you know, great founders starting companies. So, for example, in 2017, the price of crypto exploded. It went up, you know, the total market cap went up by 30x, 40x. And then in 2018, when the prices of crypto collapsed, we still saw 2x the amount of venture capital investment into traditional companies in the space as we did in 2017. So the start of 2019 in reaction to 2018 has been a little bit slower. We're not seeing as many great entrepreneurs move into the space, but with this recent Bitcoin rally, assuming it sustains, I'm pretty optimistic for the second half of the year.
Do any of you have like good guidelines for when and why it makes sense to invest via token, and when and why it makes sense to invest via equity? How do you understand like the decision-making process, you know, at a venture capital firm when you have these sort of multitude of options?
Yeah, I would say in most cases it's incredibly clear the project is a rent-seeking thing that should be a company and you should own equity in it, or it's a protocol that really needs cooperative ownership. The contribution of all of the community members is important, and so that should be a token. And if you kind of abstract back, like Bitcoin shouldn't have equity, right? There shouldn't be a Bitcoin Inc. that runs Bitcoin, right? Or Ethereum shouldn't have a company that's trying to extract value. So it's normally really, really clear. There's a few very interesting exceptions to that rule, like Brave Software is a really cool equity, and it also has basic attention token, which is a really important token, but generally it skews very clearly one way or the other.
I think if a founder has to ask, should I do a traditional company or should I do a token sale, they should almost always do a traditional company. You have to be creating a radically decentralized network that you intend to, basically step away from as a company for it to make sense to do a token sale.
And Ryan, how does Seed Invest, view something like this? What's your stance?
Well, I think the reality right now, and if it wasn't clear before, it was clear with what the SEC came out with a few weeks ago, is that if you're looking to raise money in the U.S., the vast majority of the raises for companies in the space are going to be treated as securities. So whether it is logical or not, that's sort of the reality we live in right now. And so I think unless you're looking to do something offshore, if you're looking to raise in the U.S. from U.S. investors, you have to think about securities. So we basically at Seed Invest we work with securities. We've funded about 150 companies, and we've done it all through a broker dealer. It's all regulated, so I think there's certainly a lot of companies that we see that are looking to raise money for an entity that have not sort of built out a network yet, and they're looking to raise in the U.S. They're going to have to think about raising either through Reg D from accredited investors only or through Reg CF and Reg A+. So I think that's sort of a reality that as a company you have sort of the choice of right now complying with U.S. securities laws or trying to go offshore.
Yeah, and I'll start with you, Ryan, and we'll kind of work our way down. I mean, you talk about sort of regulatory uncertainty. Do you feel like that fear is stifling the amount and the volume of investment that's pouring into the space, or do you feel like things are relatively clear but just a little squishy? I mean, what's your take on where the regulation stuff stands?
Yeah, there's no question that there's a lot of ambiguity right now. I think there has been for some time. I think for a company, like I said before, it's sort of crystal clear that the rules are such that you're going to have to be a security if you raise money in the U.S. Unless something changes in the future. And there's obviously this part of the rules that came out recently, which sort of, I guess, extrapolated from Bill Hinman's speech, which talked a little bit about whether you want to call it morphing from a security into a non-security, or you could look at it as sort of not having an active participant that you're basically relying on to hopefully have your shares appreciate. But those are high bars. So I think if you're an issuer, it's unfortunately pretty clear right now that you're going to have to go through securities laws in the U.S. On the other hand, in order for this market to function properly, you need intermediaries, and so that's where there's still a lot of challenges and uncertainty. So for the past 6 months, I believe that really anybody that was looking to apply to become a broker dealer like we are, or to get an ATS license to facilitate secondaries, there really wasn't a lot of movement because people were waiting on the SEC guidance, including FINRA, who has to abide by the SEC guidance. Now the SEC guidance has come out, but unfortunately there's still not clarity around things like custody and clearing. There's not clarity from the FINRA perspective of other things like what kind of policies and procedures do you need to follow. So I think we're getting there, but we're not there yet, and FINRA and the SEC still probably have some work left to do before we get some intermediaries that can help to facilitate both primary capital raises and certainly liquidity.
Yeah. So Dan, you recently raised a fund. I think Pantera's third, if I remember correctly. When you're out talking to limited partners, is there a lot of fear and uncertainty out there? How does the regulation fit in?
People talk about it a bit, but I actually think the regulators have generally done a very good job. All of our laws in the U.S. for securities were written to prevent 1929 from happening again, and distributed ledger technology is not easy to put in a 80-year-old framework. So they've let a lot of things develop and grow. The IRS ruled in 2013, FinCEN ruled 6 years ago, CFTC has futures. So a lot of the agencies were really, really progressive and got in there. The SEC's working through what's a security, what's not a security. It's not obvious, right? There isn't a kind of a bright line between the two. And So I think over the next 6 or 8 months that will become more clear. What is a security, what's not a security, but it hasn't really I don't think it's dramatically impacted. And the proof of that is we've traveled to 30 countries looking for investments because blockchain's obviously borderless. We've done 100 different trips. We've invested in companies in countries all over the world, but 2/3 of our investments are in the United States. And then the super trippy stat is 2/3 of those are within 2.9 miles of our offices in California. So the industry is thriving in the U.S. and the regulators I think are doing a great job.
Travis, I'll put this more pie in the sky question to you. Clearly, blockchain DLT technology is an innovation. It's enabling new things. Are there new innovations on the funding side, or as we swing back toward normal, are we just sort of recreating some of the existing structures that existed previously when it came to accessing capital?
So there absolutely are new innovations. I'd also say there are ways where nothing has changed. So back in the end of 2016, we started to see interest in ICOs and token sales, and a common line was that this was the end of venture capital, VC is dead, and this is going to disrupt the venture capital business. And I always thought that was ridiculous for a bunch of reasons. I really think that these are early stage projects where for people to make good investments, they have to have direct contact with the team, they have to have a level of expertise, and they have to know the sort of risk that they're taking. Additionally, I just didn't believe that the SEC was going to allow ICOs to exist in the form that they did. I was surprised that that boom went on for as long as it did. And so today, when you have new companies who are looking to create distributed ledger networks, they're almost exclusively selling to accredited investors only in the US, and they're receiving the vast majority of their money from venture capitalists and guys like DCG and Pantera and the other funds in the space. That being said, we've seen a lot of really interesting new structures where companies are issuing a token and finding ways to get it out into the world and incentivize people to participate in their network. But I don't think that this is going to radically change kind of how our capital markets operate, at least at the earliest stages.
Mm-hmm. And even when we're talking about sort of that clustering, that sort of remarkable clustering that you're talking about, it kind of begs the question, right? Like, is this just becoming another sort of high growth tech sector that investors have access to? I'd just be curious about your thoughts there.
Oh yeah, it does democratize access. You're seeing, even in the public equities markets, companies don't go public at 350 million like they used to. They wait till 60 billion, 70 billion to go public. So it is hard for a normal person to get access. So this does allow, tokenization does allow people to get access to projects much earlier. It does, bring some risks and rewards though, because you have these manias that go up and down.
Talk to me about just like some of the fun stuff that you're seeing, right? Crypto winter seems to be thawing a little bit. What are some of like the bellwether projects that may change the landscape, here toward the back end of 2019? Ryan, if you have any exciting stuff to shout out, or you guys chime in as needed.
Yeah, without mentioning portfolio companies, I think one
please.
interesting thing to watch will be companies that are actually raising capital from not just accredited investors, but non-accredited investors. And so you have probably a long line at the SEC of companies that are looking to get qualified through Reg A+. No one's got qualified yet, but I do think that there is probably an openness to start to allow companies to get qualified through Reg A+ and raise capital from not just accredited but non-accredited investors. Same with sort of Reg CF. So I'm very interested to see that start to open up, and for people, you can raise up to $50 million through Reg A+ from accredited and non-accredited investors. And furthermore, a lot of people don't realize this, but unlike with Reg D, you don't have to go through 144 to trade your shares. So you don't have to wait a year. You could actually trade your shares the next day through Reg A, if they're qualified through Reg A+, which is interesting to both accredited and non-accredited. So I think that becomes really interesting. I think for a lot of the reasons I mentioned before, sort of there's been a pause and it hasn't happened yet, but I think you'll start to see those for sure, and I'm curious to see what comes out of that.
So one broad category of projects that I'm really interested to watch over the rest of this year basically Ethereum competitors. So Ethereum was definitely one of the major causes for the extraordinary growth in this space over the last few years, but it has some tremendous limitations in terms of scalability and, in some cases, privacy and how easy it is to use and throughput and different things. So there's a bunch of companies that are creating competitors to Ethereum, some that are just saying that they're faster and cheaper and they'll be able to handle applications that have more users. And some of them as well that are being custom built for specific applications. So there's a few in our portfolio where they're basically building these vertically integrated platforms where they're building the new network, the Ethereum competitor. They're also going to build some of the tooling that will enable developers to build on top of this. And they're going to build some of the applications on top as well and bring on partners to do that. And the reason I think this is really interesting is that you have companies that understand what end users really need, and they can iterate on the network to work for those use cases. So one example of that is there's a company in our portfolio called Figure, founded by Mike Cagney, who was the founder of SoFi. And what Figure does is they are basically creating these tokenized securities and tokenized, specifically they're issuing home equity loan products, and they're going to tokenize them, and separately they're creating a distributed ledger network called Provenance. And Provenance is different than many of the blockchains that we've seen that have a native cryptocurrency in that it's a private permission network that is going to require all members to go through KYC. And so, there are folks in the blockchain space who would say this is anathema to what open blockchains are about. But the reality is, I don't think folks are going to be issuing security tokens en masse on top of Ethereum in any way that makes sense. So building a platform that is more controlled and more optimized for regulated instruments makes a lot of sense. There are other examples of this as well. And so what's going to be interesting to watch is still the vast majority of smart contract development in the space is on top of Ethereum, but there are dozens of other projects that are trying to compete with it. And so we'll see how much activity moves off over the course of this year and next.
Dan, what's cool right now? What space is cool? What are you looking at?
Well, I agree with Travis. I think it's great that some of these projects are going to go live, and we're going to actually see them work. 18 months ago, when we were in the peak of the mania, we were trying to remind people that 2 developers and a white paper is not going to go live quickly. It's going to take a long time. And even Augur, which is one of the first projects to go live, took 4 years. If you can do things quicker, maybe it's 2.5, 3 years to get things live. But that means over the next 6 to 12 months, a lot of really cool things that were sold 18 months ago are going to go live. So you have like Thunder and Polkadot and Filecoin going live. That's going to be really exciting. We also are very focused on the scalability issues. Bitcoin and Ethereum are amazing, but they can only do 10 transactions per second. That's not really going to compete with 15,000 that Visa does over Christmas. So there are projects like Starkware, Arbitrum, Bloxroute that allow potentially several orders of magnitude scaling on the Bitcoin brand blockchain or the Ethereum blockchain. So those are important. And the next big thing is real institutional custodians. And people have been talking about that for years. But now you have things like Fidelity going live and Bakkt and ErisX. So I think those will happen over the next, definitely in 2019. That should really kick off kind of the next leg of this.
Got it. And for any entrepreneurs in the room, what are some tips and tricks, right? We're talking about funding startups. These are people with cool ideas that, need the capital to take flight. And I keep returning to that crazy stat, the 2.9-mile cluster. I had a similar panel yesterday with Emily Choi of Coinbase Ventures, and she was saying that because there are fewer pre-existing lanes through which you can vet entrepreneurs in crypto, sometimes you fall more heavily on those relationships, like a warm intro from someone. What are tips and tricks that you can offer to any entrepreneurs in the room in terms of, contacting a firm like yours and having a successful first meeting? What's some advice you could offer?
Yeah, I don't know that that this tip is specific to the blockchain space, but demonstrating that you've actually done something is incredibly powerful. I know how obvious that sounds, but there are so many companies that come to us with big ideas and shiny pitch decks and having a really great product that you can showcase, having early traction, and focusing really on execution rather than just on marketing and messaging and branding and fluff. I'd say that's true in any case, in any space. It may be especially true in this space where we see, in many cases, such a disconnect between hype and reality.
Yeah, I just want to piggyback on what Travis said because I think that's important. And you know, if there's one other tip in addition that I would mention, and again, like not just specific to crypto blockchain space, but in general, is you know, especially in 2017, it's amazing how many companies would pitch you their idea, especially in the space. You have no idea what they're talking about, but people were throwing money at everything, and it didn't matter, and people didn't even know what valuations they're investing in. That's just not sustainable. And so, if there's one tip for people in the room, it's literally like simplify exactly what you're doing when you pitch your idea, so that if you pitch your grandma, she can actually like recite it to you and tell you what you're doing. If you know, investors can ask you additional questions and get into more detail, but entrepreneurs very often sort of are hiding what they're actually doing by talking in jargon, and just keep it really simple. And if there's a business behind it, people should understand what you're doing.
Dan, what are some of the signifiers of a potentially successful entrepreneur to invest in this space specifically?
So I'll give a story of what not to do. So at the peak of the mania and the ICO boom, I bumped into a person I knew in the industry at a conference like this, and they're like, hey, we're doing an ICO, we want you to buy it. We've already got a merchant bank to help us market it. We've got all these advisors. We've got the white paper, we've got a website, we've got all this. We're just now trying to figure out what the utility is. And I was like, okay, that's really sketchy. I have to leave. So it really is just actually coming up with something that is useful, that people want to use, that is technically feasible, that, you know, it doesn't take 1,000 developers 1,000 years to actually build. And if you have that, send an email to dan@panteracapital.com.
Yeah.
Wow. Maybe a tip too for investors. You know, in 2017, we had so many companies in the space that came to us that you know, wouldn't be able to raise $1 million at $3 million pre-money, and somehow they went and raised like $40 million. And for investors, I mean, people in our office that were like, oh, you got to invest in this you got to buy these tokens, and I'd ask like, well, what's the valuation? What do you think it's worth? And like, it doesn't matter. Like, I'm going to be able to resell it for more, you know, in a month. And that's not investing, right? You need to actually. It doesn't matter. Sort of whether it's a token or not. It's investing 101 still applies, which is you need to sort of know what you're investing in and what valuation, and have a thesis for that it's worth more or going to be worth more over a certain period of time. And I think that the market's become more rational, but that's something that certainly make sure you keep in mind.
Cool. Wanted to get a couple, 2-3 questions from the audience. If anybody has one, start making your way toward those microphones. First guy to the microphone wins it, and then you can go next. All right. What's your question, sir?
So the last ICO boom really peaked with CryptoKitties clogging the Ethereum blockchain, and Ethereum has been a dumpster fire since then. So I would like to ask, what do you think about the liquid sidechain for Blockstream and the tokenization coming from Liquid and Blockstream? Any thoughts on that?
On sidechains specifically, I think it's one of several approaches to solving the scalability issue. I think in many instances it might make sense. I think in other cases people are trying to do this kind of at layer one. I don't have a strong view on which of these is going to win, but I love to see innovation on that front.
Did you pass the baton? Did you? I said this guy could do the next question. You want it? Yeah, get up.
Hey there. My name is Georgi, and I'm a founder of two HR tech startups. My question is, what do you think is the future of startup valuation? And because currently we see companies just starting with hundreds of millions of valuations, and with those security tokens and ICOs and IAOs or whatever abbreviation is.
You're saying startup valuations?
Yeah, startup valuations. Yeah, I think they're kind of broken at the moment in the industry.
I'm happy to take it. I don't think startup valuation should be any different personally. You guys might have other thoughts, but I think the enterprise value of your company or your project or whatever is still the enterprise value of your project, and whether it's private or public or however it trades. I think you need to know what percentage you own of that, and I don't think that necessarily changes. But
I'm seeing some nodding, some agreement. Is that the general consensus? Is there a new way to think about valuation in this space?
Not really on the venture side. I think there's, during the peak of the bubble, there were definitely some early stage valuations in the space that were a little outrageous for companies, not for tokens. But you see that in tech, in Silicon Valley generally. I mean, we've seen, I guess we just kind of crunch the numbers for all the deals that we've done, and we do like 25 seed deals a year. So in 2016, the average seed deal was, that we did was, I think, 1.8 million at a 9 million pre-money. And then in 2018, it jumped to like 3.2 million at 12 million pre-money or so. So, valuations are ticking up, and round sizes, especially for seed deals, are ticking up substantially. I mean, that was like a 75% increase in 2 years. But that's also what's happening in tech in general. So I think
part of that also is just what you call a seed deal versus Series A now is morphed and changed over the last 10 years. And
that's true as well.
Yeah, and I think back in the day, we were funding, kind of crazy libertarian utopia projects with people with no experience. And so, yeah, the prices probably were lower, and now we're funding seasoned entrepreneurs spinning out of Google or Facebook, building something that is clearly got a use case. So, we've seen it as well. Our average valuations are higher than they were 5-6 years ago, but we're investing in things that are probably less risky.
Keep in mind, we're also in like a 10-year bull market right now, and everything's cyclical, so we'll see if that lasts.
Cool, one more question over here, and I think that'll wrap us up.
In the current environment, is the venture community willing to do fixed price common instead of Series A preferred for a growth round?
We're not.
No,
I love your thoughts, but we still only will do preferred stock or convertible notes that convert into preferred stock. But
we've done a few common share deals, but it's very rare. It's very specific to the circumstances.
Yeah, we've done some internationally where it's more the norm, often for some tax reason or some regulatory purpose, but generally speaking, VCs want preferred stock, meaning that in a liquidation, they get their money back first because they were the last ones to put capital in.
Certain countries like the UK, they'll call it common equity, but you'll still get a 1x liquidation preference, which is the most important protection.
Cool, I think that's going to wrap it up. We are running into lunch, so we'll let you go grab some food. Thanks for joining us at Consensus, and join me in thanking